Hi there, a lot of talk lately about gold and silver reacting to the Fed, but I think the bigger story is not just what the Fed did. The bigger story is what the Fed is becoming. So, in this video, we're going to separate the headline from the signal, and you are going to walk away feeling a lot smarter about metals, rates, inflation, and why oil suddenly got pulled into the same conversation. Today is Sunday, May 3rd, New York time. Comment below what day and date you're watching from because it helps me see where this market conversation is reaching. And if you value this type of breakdown, support the channel by subscribing and commenting John A.G. Best, because it helps real analysis travel farther than recycled noise. So in case you missed the headline, the Fed held rates right where they were. No dramatic cut, no surprise hike. Just another hold around the mid 3% range. On the surface, that sounds boring. And honestly, if all you saw was the rate decision, you could be forgiven for thinking, okay, nothing really happened. Except something did happen. Because underneath that calm headline was a very divided room. The official statement still talked about an economy expanding at a solid pace, inflation still sitting above comfort, and energy prices making the outlook harder to read. That matters because gold and silver do not simply react to today's rate. They react to the market's belief about tomorrow's policy, tomorrow's dollar, and tomorrow's trust in the people running the system. That's why this week felt so choppy. Gold pulled back from the excitement it had earlier in the year. Silver had its own strange behavior because silver is not just a monetary metal. It is also tied to factories, electronics, solar demand, and the broader growth story. So when traders hear rates may stay higher for longer, they hit metals. But when investors hear inflation is still sticky and the central bank is divided, they start wondering whether those same metals are still insurance. Both reactions can be true. And that is what makes this moment tricky. If you only look at one day of price action, you might think the metals thesis broke. If you zoom out, gold is still sitting at extremely elevated levels compared with last year, while silver is still carrying a much stronger, longer-term move than most people expected. So the market is not saying the story is over. The market is saying the easy part may be over. Now here's the part people are not talking about enough. This was not just another Fed meeting. This was probably one of the final meetings of the Powell chair era. Powell's chair term runs out in the middle of May, but his seat on the board runs longer. That creates a weird setup. A new chair can arrive, but the old chair may still be in the building, still voting, still carrying institutional weight. And in a normal year, maybe that would be trivia. This is not a normal year. Political pressure around the Fed is no longer background noise. It is front and center. The White House wants easier policy. The inflation data says, not so fast. Oil is unstable. The labor market is not giving a simple green light either. And the bond market is looking at all of this saying, wait a minute, maybe the next move is not even a cut. That is why Kevin Warsh matters. His nomination has moved forward, and markets are now trying to figure out what kind of Fed he would actually run. Not the campaign version, not the hearing version, the real version. Would he be more willing to cut? Would he be more focused on credibility? Would he change how inflation is discussed? Would he narrow the Fed's mission? These are not small questions because the answer affects every asset class you care about. Stocks care, bonds care, gold cares, silver definitely cares, and the dollar cares most of all. Now, one phrase around Warsh has gotten a lot of attention: price stability. He has described success in a way that basically means inflation should not be something ordinary people have to think about constantly. And on the surface, that sounds perfectly reasonable. Nobody wants to live in an economy where groceries, gas, insurance, rent, and utilities are always the main topic at the dinner table. But then comes the important question: how do you measure that? Because if the Fed leans more heavily on trimmed inflation or median inflation, you may get a cleaner read of the trend. To be fair, that is not automatically dishonest. Economists use those measures because monthly inflation can be noisy. If one category explodes because of a temporary shock, it can distort the whole picture. But here is the counterpoint. If the thing being trimmed out is the thing families are actually paying, then the cleaner number may feel less honest, not more honest. A household does not pay trimmed gasoline. A business does not pay median freight costs. A family does not open a trimmed insurance bill. They pay the real bill, and that is the risk. Based on recent public analysis, trimmed measures can be useful over longer periods, but they can also understate the pressure people feel when energy, tariffs, or other shock categories are moving fast. So if a new Fed leadership team starts sounding like it wants to change the scoreboard while inflation is still above target, some investors will immediately ask whether this is better measurement or just softer messaging. That question alone is gold relevant. Gold loves moments when trust gets blurry, not panic exactly, not the end of the world. Just that slow, uncomfortable feeling that official language and real life are not matching perfectly. Silver can benefit from that too, but silver has to fight another battle at the same time: growth expectations. If investors think higher rates will slow the economy, silver can lag, even while the monetary argument improves. So what do we do with the gold chart? There are analysts looking for another leg lower. Maybe gold drops toward the low 4,000s. Maybe it bounces. Maybe it washes out deeper into the mid 3,000s before the next major long-term entry. I am not dismissing that. After a large move, markets often need to punish late buyers before they reward patient ones. But I also would not treat any chart target like prophecy. A chart is a map. It is not the weather. It can show support zones, pressure points, and likely reactions. It cannot tell you whether oil spikes again, whether inflation expectations jump, whether the dollar rolls over, or whether central banks keep quietly adding gold to reserves. And this is the key distinction. A pullback can be bearish if the reason is real yields rising, the dollar strengthening, and long-term buyers stepping away. But a pullback can also be healthy if the reason is leveraged, traders getting flushed out while the bigger structural bid remains. The candle may look the same. The meaning is completely different. One more thing. The physical market is not always moving with the futures screen tick for tick. Jewelry demand, central bank behavior, coin premiums, and industrial restocking can all move at different speeds. That means a futures sell-off can look dramatic while some physical buyers simply wait for better prices. And when those buyers return, the same crowd that called the move dead suddenly has to explain why support showed up where fear was loudest. That is the part you cannot see if you only stare at one red candle on a screen. That is why I do not like emotional gold analysis. If gold goes up, people scream collapse of the dollar. If gold goes down, people scream the bull market is dead. Both reactions are lazy. The better question is, what changed? Did the debt picture change? Did fiscal spending suddenly become disciplined? Did inflation credibility suddenly get restored? Did geopolitical risk disappear? Did oil become boring again? No. None of that happened. So, yes, the bottom may not be in, but the long-term case has not disappeared just because the short-term chart got uncomfortable. If you're successful, share your success story in the comments so others can stay motivated. And share the mistakes too, because sometimes the most valuable lesson is not the trade that worked, but the trade that taught you patience. Now let's bring oil into this, because oil is the bridge between the Fed story and the metal story. The United Arab Emirates has decided to leave the main producer group and the wider alliance tied to it. That is a big deal, not because barrels instantly flood the market tomorrow morning, but because it changes the psychology of coordinated supply. This is a country with the ability to produce far more than its assigned quota, and it has spent years building capacity while being told to stay within limits. Think about that. If you are investing billions to expand output, and your group keeps telling you to hold back, eventually the national interest and the cartel interest start pulling in different directions. The group wants price discipline. The country wants flexibility. The group wants unity. The country wants revenue, market share, and strategic independence. So the exit is not random. It is a signal. But here's another place where the simple explanation breaks down. More independent UAE supply could eventually be negative for oil prices. Yet the first reaction can still look bullish if traders see the exit as a sign that the old coordination system is weakening during a regional crisis. Markets do not just price supply, they price uncertainty. And right now, uncertainty is everywhere. Recent energy outlooks have pointed to a large disruption premium tied to the region, with expectations that prices stay elevated until shipping and production normalize. The Strait of Hormuz issue is crucial here. If barrels cannot move smoothly, capacity on paper does not immediately become supply in the market. That means the UAE may have more theoretical room to pump, but the world may not feel all of that supply right away. So this oil story cuts both ways. If supply eventually increases, inflation pressure could cool. That would help the Fed and maybe pressure gold in the short run. But if the transition creates more instability first, oil stays high, inflation expectations stay nervous, and the Fed has less room to cut, that can pressure metals through yields, but it can also support metals through fear and credibility risk. This is why the market feels so contradictory. Higher oil can hurt gold because it delays cuts. Higher oil can help gold because it increases uncertainty. A stronger dollar can hurt gold because it makes the metal more expensive. A stronger dollar can also hide deeper doubts if investors believe the Fed is trapped. That is not a clean market. That is a tug of war. And silver is standing right in the middle of it. On one side, silver has monetary demand, investment demand, and the possibility of people rotating into it when gold feels too expensive. On the other side, silver has industrial exposure. If higher rates slow manufacturing or solar spending, silver can get hit harder than gold. That is why silver often moves like it has two personalities. One personality wants to be money. The other wants to be copper with a shine. So when you see silver bounce one day and fade the next, do not automatically call it manipulation. Sometimes it is just the two sides of silver fighting each other. Now let's pull the whole thing together. The Fed held rates, but the vote told you the committee is not united. Powell may be leaving the chair seat, but he may not be leaving the institution. Warsh may be arriving, but markets still do not know whether he will prioritize credibility, easier policy, or a new inflation framework. Gold may be correcting, but its long-term drivers are still alive. Silver may be volatile, but its dual role is exactly why it can frustrate people before it surprises them. And oil may eventually loosen if the UAE produces more freely. But the path from here to there is full of geopolitical risk. That is the real story. Not one headline, a chain reaction. Rates affect the dollar affects metals. Oil affects inflation. Inflation affects the Fed affects yields. Yields affect gold. Growth affects silver. Politics affects confidence. Confidence affects everything. So what should you watch next? Watch whether inflation cools outside energy, because if services stay sticky, the Fed has a problem. Watch whether the next Fed language removes the easing bias, because that would tell you the hawks are gaining ground. Watch whether Warsh talks about inflation measurement in a way that builds trust or creates suspicion. Watch whether Powell's board presence becomes stabilizing or awkward. Watch whether UAE barrels actually reach the market or just remain capacity on a spreadsheet. And for gold, watch the reaction to bad news. If bad news keeps pushing gold lower and buyers disappear, be careful. But if bad news hits, gold dips, and strong hands keep stepping in, that tells you the bigger bid is still alive. For silver, watch whether it can hold up when growth worries rise. If it can, that would be a stronger signal than a quick spike on a good headline. So no, I do not think this week proved that gold and silver are finished. I think it proved that the next phase will be harder, more political, and more dependent on trust. The easy narrative was, Fed cuts are coming, dollar weakens, metals rise. The harder narrative is, inflation stays sticky, oil stays unstable, the Fed changes leadership, and metals have to climb a wall of confusion. That is not bearish by itself. It just means you need a plan. If you are buying metals, know whether you are trading a chart or building insurance. If you are waiting for lower prices, know what level would actually make you act. If you are already positioned, know whether volatility changes your thesis or just tests your emotions. Because markets do not reward panic, they reward preparation. If this breakdown helped, subscribe for more calm, clear market analysis and comment below. Do you think gold already put in its low, or does it need one more real washout first? Also, do you trust inflation numbers that remove extreme categories, or do you care more about the prices people actually pay? And remember, this is for education and perspective only. I am not telling you what to buy, sell, or hold. Your portfolio has your name on it, not mine. So make decisions based on your own risk, timeline, and plan.